Dear plus 2 accountancy students, good morning. Today we shall discuss the 9th chapter, Ratio Analysis. In this session, book back theory questions are shared with you. Book back theory questions. Very short answer questions are taken now. What is meant by accounting ratio? What is meant by accounting ratio? Ratio is a mathematical expression of relationship between two related or interdependent items. It is the numerical or quantitative relationship between two items. It is calculated by dividing one item by the other related item. When ratios are calculated on the basis of accounting information, these are called accounting ratios. Accounting ratios can be expressed in any of the following forms: pure, percentage, times. What is quick ratio? Quick ratio gives the proportion of quick assets to current assets. It indicates whether the business concern is in a position to repay its current liabilities as and when they become due out of its quick assets. Quick assets are current assets excluding inventories and prepaid expenses. It is otherwise called liquid ratio or acid test ratio. It is calculated as follows: quick ratio equal to quick assets by current liabilities. Next question. What is meant by debt equity ratio? Debt equity ratio is calculated to assess the long-term solvency position of the business concern. Debt equity ratio expresses the relationship between long-term debt and shareholders' funds. Debt equity ratio equal to long-term debt by shareholders' funds. Long-term debts, debentures, long-term loans. Shareholders' funds, equity share capital, preference share capital, reserves and surplus. What does return on investment indicate? Return on investment shows the proportion of net profit before interest and tax to capital employed. This ratio measures how efficiently the capital employed is used in the business. It is an overall measure of the profitability of a business concern. Return on investment equal to ROI equal to net profit before interest and tax by capital employed into 100. Capital employed equal to shareholders' funds plus non-current liabilities. Greater the return on investment, better is the profitability of a business. Fifth question. State any two limitations of ratio analysis. Ratios are only means. Ratios are not end in themselves, but they are only means to achieve a particular purpose. Analysis of related items must be done by the management or experts with the help of ratios. Accuracy of financial information. The accuracy of ratio depends on the accuracy of information taken from the financial statements. If the statements are inaccurate, ratios computed on that will also be inaccurate. Change in price level. Ratio analysis may not reflect the price level changes and the current values as they calculated based on the historical data given in financial statements. Okay students, thank you.